Financing a $70,000 pickup truck on an 84-month loan while working at a Wendy's salary is the financial equivalent of skydiving with a parachute made entirely of single-ply toilet paper. It sounds absolutely absurd when you say it out loud, but it is happening every single day all across the country. Welcome back to the channel. By the time this video ends, you are going to understand exactly why the subprime auto loan bubble is quietly ticking down to an inevitable implosion, one that is going to drag the entire credit market down with it. We are going to peel back the layers of this broken system and translate all the Wall Street jargon so you, the everyday retail investor, can see exactly what is coming. Before we dive into the terrifying underlying data, let's rewind for a second and set the stage. Think back to the 2008 financial crisis. If you were paying attention back then, you remember the infamous ninja loans that blew up the housing market. No income, no job, and no assets. Wall Street and predatory lenders were handing out $500,000 mortgages to absolutely anyone with a pulse. They took those terrible loans, bundled them up into complex financial products, stamped them with a shiny AAA rating, and sold them to global investors as completely safe. We all know how that ended. The global economy practically melted down, millions lost their homes, and we all collectively agreed that giving massive loans to people who cannot afford them is a uniquely terrible idea. But here's the secret the mainstream financial media isn't telling you. Wall Street didn't learn a moral lesson in 2008. They just repackaged the exact same scam. Instead of doing it with houses, which historically might actually go up in value over a 30-year timeline, they're now doing it with depreciating assets. They swapped out suburban McMansions for Nissan Altimas and lifted pickup trucks. If you turn on the news today, the financial anchors in sharp suits will try to sell you a very comforting mainstream narrative. They'll say the economy looks great, consumer spending is incredibly resilient, and people are out there buying cars. It all sounds fantastic on the surface, but looking at the mainstream economic data right now is like going out with a Tinder date who aggressively calls himself an entrepreneur, that it turns out he just sells solar panels door to door. The shiny surface is a complete illusion. Underneath that surface, the data tells a terrifying story. Everyday Americans are absolutely drowning in debt. The dirty little secret driving this entire industry right now is something called negative equity. Negative equity, or being underwater, simply means that you owe the bank more money for your car than the car is actually worth. In a healthy economy, if you owe $20,000 on a car that is only worth $10,000, a bank would laugh you out of the building if you tried to trade it in for a luxury vehicle. But we aren't in a healthy economy. Today, dealerships are more than happy to take your underwater trade-in. They simply roll that massive negative equity right into the financing of your brand new vehicle. And to make sure your new monthly payment doesn't look like a mortgage, they stretch those loan terms out to 84 months. That is 7 long years of payments on a car that loses value the second its tires touch the public road. Let's do a deep dive and break down the mechanics of this because I want to show you exactly how the systemic debt crisis is being engineered. I want you to imagine an 18-year-old broccoli-haired teenager. He just watched a 6-hour marathon of David Goggins podcasts, he's hyped up on energy drinks, and he has decided it is time to hustle and show the world he is successful. So he walks into a local dealership. He wants to buy a Dodge Hellcat. He has a part-time job, terrible credit, and the beat-up sedan he drove to the lot still has a $10,000 loan balance on it, even though the car itself is practically worthless. The dealership's finance manager doesn't see a massive financial risk, he sees a massive commission check. The Hellcat costs $70,000. Because our teenager is underwater on his trade-in, the dealership rolls that old $10,000 debt into the new contract. Now this kid is financing $80,000 for a $70,000 car. Because his credit score is hovering somewhere around room temperature, the lender hits him with a 29% interest rate. To keep the monthly payment low enough that he can still afford his Discord server subscriptions and his meme coin investments, the bank stretches the loan out to a staggering 84 months. He drives off the lot feeling like a king, completely oblivious to the fact that he has just financially ruined himself before his 20th birthday. This scenario isn't an exaggeration. It is the fundamental business model of the subprime auto industry right now. The dealership doesn't care if this kid defaults in 2 years because the dealership isn't keeping the loan. They sell it off immediately. And this is where the Wall Street machinery kicks into high gear. Just like the mortgage-backed securities of the 2008 crash, these predatory subprime auto loans are bundled together by the thousands. Wall Street banks chop them up into tranches, get a credit rating agency to bless the top tiers as safe investments, and then sell them off as auto asset-backed securities. Who buys them? Pension funds, retirement accounts, and massive institutional investors who are desperate for yield. The institutions buying these securities are playing a dangerous game, relying on the greater fool theory, assuming they can collect the high interest and pass the risk onto someone else before the bottom falls out. Wall Street takes the absolute worst, riskiest debt in the country, throws it all into a blender, and serves it to the global financial system as a premium smoothie. Let's look at the macroeconomics of this disaster, because the fallout goes way beyond one teenager losing his Hellcat. The real terror of this subprime auto bubble is the sheer scale of the negative equity. Let's say we are 3 years into that 84-month loan. The car has depreciated rapidly. It has mechanical issues. The owner misses a payment, then another. The repo man shows up in the middle of the night and tows the car away. The bank now has to auction off that repossessed vehicle to recoup their money. But remember, the owner financed $80,000 on a $70,000 car. 3 years later, at auction, that battered Hellcat might only fetch $35,000. That leaves a massive, unrecoverable hole in the balance sheet, a complete loss. Now take that one specific framework of financial ruin and multiply it by millions of over-leveraged consumers across the entire country. We are literally building a systemic credit crisis on the backs of depreciating metal boxes. When a critical mass of these loans default, the securities backing them will begin to collapse. It creates a massive contagion effect. When those auto asset-backed securities start failing, the credit markets will freeze up, just like they did in the past. Banks, spooked by the massive losses in their auto portfolios, will severely tighten their lending standards. That booming private credit market we have seen expanding over the last few years, it will dry up in an instant. Suddenly, the cross-currency carry trades and complex liquidity loops that keep the broader markets functioning will violently unwind. Small businesses won't be able to get loans to meet payroll. Normal people with perfect credit scores won't be able to get a mortgage. The entire system grinds to a halt because it was propped up by consumers financing lifestyles they could never actually afford. It is the ultimate anti-establishment reality. Wall Street banks collect up all their securitization fees up front and walk away completely clean, while you, the everyday retail investor, end up paying the ultimate price when the systemic shock finally hits the broader economy and bleeds into your retirement portfolio. We are all sitting around waiting for the new GTA 6 trailer to drop, but the absolute most insane Grand Theft Auto is happening legally, right now, in broad daylight, inside the finance office of your local car dealership. The system is fundamentally broken. It isn't designed to help the working class build wealth. It is designed to trap them in a perpetual cycle of unpayable debt attached to an asset that mathematically guarantees a loss. So I want to zoom out and ask you all a question. I want to hear directly from you. Are you seeing this play out in your own town? Are the repo trucks working overtime in your neighborhood, dragging away cars that people had no business buying in the first place? Drop your take in the comments right now. Let's get a conversation going. Do you think this subprime auto bubble is going to be the exact pin that finally pricks the broader economy? If you want to keep peeling the onion and uncovering the real mechanics behind the financial system that traditional media is too afraid to touch, make sure you hit that subscribe button. Stay sharp, stay out of bad debt, and I will see you in the next one.